With stocks hitting record highs, thanks in part to the prospects of big tax cuts, Steve Mnuchin is waving a flag of caution. In an interview on the Politico Money podcast, Mnuchin said, quote, "To the extent we get the tax deal done, the stock market will go up higher. But there is no question in my mind, if we don't get it done, you are going to see a reversal of a significant amount of these gains." Joining us from Los Angeles is Ben Emons. He's chief economist and head of credit portfolio management at Intellectus Partners. Ben, great to have you on. Agree or disagree? And if we do see some softness here in stocks, is it a buying opportunity?
It still remains a buy on the dip mentality, Julia, because as you outlined, and also as this beige book as well outlines, right, you have moderate growth with tiny labor markets, and so a very benign environment in terms of inflation, low interest rates, and so that all keeps us in a bind of like ever grinding higher stock markets. And I should say too, there could be big disappointment if eventually this tax reform doesn't happen. But the market seems to be convinced that ultimately there is a bipartisan support to get that reform passed. So the market keeps banking on this idea of a moderate economy with low inflation and ultimately a tax reform.
Ben, what kind of effect would this warning have on the psychology of the market, especially after prices have been melting up all year long? And it's generally acknowledged that we're fairly late in the cycle.
Yeah, that's true, Scarlet. I mean, there is this idea that we're at record highs, and that makes people uneasy. And you can see it from investor surveys, right? People are moving towards more conservatively positioning to potentially see some sort of a correction in the market. Yet that conservative feeling also pulls the market again higher because people can't stay behind. So the psychology of investors is sort of twisted in the sense of like stay conservative and liquid, and yet you cannot really not participate in this rally. If you don't want to participate, then you're going to lose out, right?
And we're seeing that from fixed income investors here too. As you say, they're playing defensive here. They've got record weightings in short-term debt securities in particular.
Yeah, that's true. So the short-term debt securities, short duration, is really what the fixed income investors currently have, in addition of taking more higher quality securities in their portfolios. And that's a reflection of a view of the economy itself, that eventually we're going to move towards a much slower economy, potentially risk of recession. And that's also what the yield curve perhaps has been signaling, this ongoing flattening, that eventually we will end up in a milder growth environment, or if not recession. So that's the defensive play that people have taken on. Our bond investors are always more conservative than stock investors. But I think it's a signal of that what's ahead of us in the next sort of year to 2 years.